conventional wisdom is that interest rates can affect the value of property and investment vehicles effectively. But I think in the current stage of the cycle, the potentially negative factors of interest rates are really not at play. The gap between bond yields, for example, and property yields has been one of the largest that has been for some time, and that still remains to be the case. The local government devolution bill is making its way through Parliament, focusing on planning, transport and housing and policing as well. A lot of the cities being able to have their own mayors, and Manchester being the blueprint for that. We are constantly inundated ourselves as investors with alternative debt funders approaching us. They're doing that mainly because of higher returns, first of all. They're doing it also because of their risk appetite. They think they can also move from that debt space to the higher equity space as well. There is a lot of these debt funds that have been established, and as a result of which I think they are becoming very competitive. I think we are going to see and continue to see some further deal flow. A lot from the non-performing loan buyers obviously out there, but they themselves are also now selling a lot of the underlying assets on which the loans they've actually acquired themselves. Here I've given you examples of 4 portfolios that we acquired. The first one was back in September 2008, which was just before the global financial crisis, where you'll see with interest rates effectively being quite high with the swap rate, but with the margins being lower, the cash-on-cash yield was about 5.1% back in September 2008. However, if you look at a more recent portfolio on the right, which is effectively portfolio 4, there you'll see the cash-on-cash yield that we're getting is 12.5%. So without actually necessarily putting high leverage, that's about a 50% leverage. So there is good opportunities to capitalize with interest rates being where they are and the availability of debt.